All right, everyone. We're live for Deal or No Deal. We're gonna get started here in just a second. I'm actually streaming live on the YouTube channel for those that are watching on YouTube. It's still setting up the meeting. Should take a few more seconds. Just did it like an hour ago and it took like 10 seconds. Now it's doing it, maybe because of the bandwidth. All right, now we go. So we should be on YouTube now as well. So I'm gonna turn that off so we don't hit that. Oops. I just hang up on you guys. Elvie, can you still hear me?
Yep, yeah, you're good.
Can you see if it's, can you go to YouTube real quick and make sure it's still live or did I hang up on it?
Let me see here.
I don't know if I did when I hit that because I had it, I was getting replay. Do, do, do. Am I still on? I'm remote today, so I
Yeah.
don't have my full system. All right, awesome. All right, guys, super excited about this. We've shifted a little bit and we're really going to start focusing on deals, on what I do, how I do them, when I do them, why I do them. And I'm going to show you exactly what I do each and every day, what you guys should look at doing each and every day if this is the space that you guys want to be in. Some people may not want to be in the space. Some people may want to be in it, maybe on the fence, not sure yet. I don't know. We'll figure it out as we go along. So we got some more people coming in. We had quite a few registered for the call. Almost switched it over to a webinar because of the amount of registrations, but we're going to keep it at Zoom. I prefer Zoom. I can stream it in the YouTube. We can record it. It's easier for me to manage answering questions because this is live. So you might be watching the recording, but the whole point of doing this is to educate and show you exactly the things that I'm doing currently in the community and just in my regular day to day. So we're going to break this down briefly and show you on today's deal. We're going to talk about how, if you're a wholesaler, how you can make money on these deals. If you're a buy and hold investor, how you can make money. If you're a realtor, what you should be doing or what you can be doing. If you're a private money lender, how to protect the deal and do it. And more importantly, I'm holding these notes. I'm creating the note. That's why I'm the note guy. I've been doing this. I've almost done over 2,000 notes. 2,000 notes. Actually, probably more than 2,000. You create first and seconds, plus all the other stuff that we've done. But the reason why is because when you understand how amortization works, is the reason why we built the Deal Evaluator software. When you understand how this works, there is no reason to do anything else, in my opinion. Remember, I'm not telling you what to do. I'm just telling you what I do and why I do it. It's up to you to determine if it's the right fit for you or not. There is a reason why banks are in the banking business. Okay. There is a very good reason why almost every of the large size skyscrapers are building any market today are banks because they control real estate and they don't own it. A lot of people want to own it. Cool. Knock yourself out. Don't really care. Not my gig, but it is a lot of other people. We're talking about how to control real estate by creating mortgage notes, how to stay in the deal, generating cash now, cash flow, cash later, and by utilizing systems and technology to help you analyze these deals. So I'm going to get right into it. Guys, if you have any questions as I go along, just raise your hand virtually. And when I get a stopping point, if it's appropriate, I'll bring you on and we can ask the question or put it in the chat and we're going to go through it. So we're going to go through one deal here. I am going to, I got to switch screens real quick. Give me 1 second. On the wrong tab. Go back over here. One man show today. I'm on a remote. Okay, great. So I am going to pull this up. And you guys should be able to see my screen now. Elvie, can you see the Deal Evaluator screen?
Yep. Yes.
All right, super. All right, here we go. I'm going to get right into this now. So move this menu bar out of my way so I can see what I'm doing. Guys, so the software is what I built and I use. I have a spreadsheet version of it. It's good, but it's not nearly as good as the software. And the software allows me to look at deals in a very fast, accurate manner. And it lets me modify the deal that comes in. I can adjust things as we go along. So I will show you as we go along. This is a deal that I'm looking at right now. In fact, if anybody wants this deal, it's available. If not, I'll probably keep it. I can't keep every deal. I would have to do 3 deals a day right now to keep everything. And some things I want to keep and some things I don't, because I do other things as well. So here is the deal. Okay. It's in the Deal Evaluator software. You can go to Nick the Note Guy. Matter of fact, I'll show you this real quick. NickTheNoteGuy.com. If you go to NickTheNoteGuy.com, you can see everything that I'm using and I'm talking about here. If you go down to the bottom, here's all the things that you would need from acquisition to disposition to help run your business. Okay. They're different companies. They're run by different people. Some of them I'm involved in, some of them not. But you can see it right here. Okay. We're going to talk about the note creation side. You're going to talk about the educational side. I'm going to refer to these companies by name. So guys, just go here, click on the links, do whatever you want to do, and we can go from there. So let's get right into this first deal. I'm going to go back to my deal evaluator over here. And let's get going. So this property is on Meadow Creek. It's in Fort Worth, which is in the Dallas-Fort Worth area. And let's just go through the deals, okay? When we put the data in, okay, when you put the data into the deal evaluator, it's going to use technology, API interfaces. Right now, this data right here is coming from Zillow. So it's going to look at current market values. It's going to look at rent values. It's going to look at a lot of different things. It's also going to pull tax data, things along those lines. And we're building on the right a summary over here, which is on the right. We're going to talk about this as we go along, but as you build it, it builds a summary. If this wasn't built, there would be nothing on here right now until you start putting the address in. So the rearages is up here. This is only appropriate if it's a house that doesn't have any debt on it, doesn't have a mortgage, but maybe the seller is behind. They're behind on property taxes, or behind on property liens, or there's liens, or there's HOA fees or something. We don't, very rarely do we ever use it. And then we go into the next portion, valuation. This is where we're establishing. So if you're a wholesaler, you may want to use this information if you're going to figure out your maximum allowable offer, less repairs, less profit. If you needed to put any repairs in there, you would just put it in there. This house needs 0. Okay. And we'll show that in a second. So the as-is value, which comes from Zillow, shows it at 272. The ARV is 275. Monthly rent, $2,000, 2081. All these you can change anyways. If you pull your numbers and you go, hey, that's a 20. Excuse me 1 second on what happened there. If I go down here and I want to change this to 2,500, I just change it. Not a big deal. If I think the ARV is 295, just change it. These are just numbers for your own benefit, so you can analyze the deal multiple different ways. Only thing we're going to talk about on these calls on the deal evaluator is what I do. And the only thing I do is wrap mortgages, period. We're not going to talk about commercial on this call. Not going to talk about pad splitting on this call. Not going to talk about buy and hold on this call. Not talking about any of that stuff. Okay. We're talking about wrap mortgages, and that could be either wrapping a seller carryback debt that's free and clear, or it could be subject to. This particular deal is subject to. And you can choose between if it's a cash purchase, subject to, or owner finance in the software. This is subject to. 90%, yeah, probably 80% of the deals right now are subject to. 20% are seller carryback, seller financing. True seller financing, no debt. Okay. So let's go ahead and continue to go through this. Okay. We're going to go to the next screen. And now we're into the mortgage data. Now, I personally like to have mortgage data first before I do anything. So if I'm dealing with an agent and they have a property on market, I want the mortgage statement. If it's a seller, I want the mortgage statement. If it's a wholesaler, I want the mortgage statement. The reason why I want the mortgage statement is because it tells me everything I need to know about the deal. It's real. It's not guesstimated. Okay. Sellers might say, oh, I think the rate's about 3.5%. Well, 3.875 is not the same as 3.5. Okay. And it could be the other way. It could be 3.25. So you need all this information. Okay. Plus, I want to know what the arrearages are. How long have they not been making payments? I want to know, are they the only borrower on the mortgage note? Who is the lender? Okay. What type of loan is it? These are all integral pieces that we use and I evaluate when I'm making my final offer on the deal. So this is coming via through a wholesaler that already negotiated this deal. Okay. And through an agent. So this was an on-market property with an agent, I believe. Okay. We get so many of them, I get them confused, but it doesn't really matter. So the unpaid principal balance, 229, 226 comes directly off of the mortgage statement. Cash to the agent is real estate agent. Assignment fee from the wholesaler is another $5,000. Okay. These are the costs. So in the model right here, in this acquisition section, we have variable and fixed expenses cost. Okay. The cash to an agent is a variable expense. If I want to say I only want to pay you $5,000, I can tell them $5,000. If I want to tell the wholesaler I only want to pay them $6,000, $4,000, I can tell them. What's not a variable expense, what's fixed, closing costs. Closing costs are extremely expensive in a creative financing, especially a sub-2 transaction, $4,500. That's the number. You ain't going to go get it for $3,000 because you're not going to get these deals from us, or we're not going to close them. That's the cost. That is a fixed cost. This particular deal, there's no arrearages, but let's just say they were behind on a payment, $10,000. We would put $10,000 in arrearages. That is non-negotiable, right? We're not going to negotiate arrearages down. We're going to bring it current at closing with the cash that's requirement. And cash to seller, that is a variable. If we wanted to we're going to run this model. We've already ran the model, so these are the numbers that we're at right now. But I could very easily offer the seller less money. I could offer more money, depending on what the terms of the deal are. These are the terms. So right now, when you add up all these things, the total acquisition cost is $33,500 to get into this deal. Guys, no, you can't get. There's not a single deal on this planet. Well, I shouldn't say there is. I have not personally seen a single deal in my 20, how long have I been doing this now? 26 years of creative financing. I had a deal where I did not have to come to the table with at least some money because I got to pay. What do I got to pay? I got to pay at least the closing cost. Okay. That's not free. Okay. Even if I found the deal myself and the seller agreed to zero, I still got to pay closing costs. I still got to pay a title policy. Somebody's going to have to pay it. Very rarely you're going to get somebody to pay all that stuff and give you the keys and give you the debt and give you all this stuff. Okay. So, and my biggest thing I see people doing when they look at these deals, they go, the cash on cash return is X. Well, if you're not putting the acquisition cost in there, I think it's an unrealistic number because that number still got to get paid off. But this deal right here, we're going to show cash now, cash flow, cash later, and how to leverage the whole deal. Because this $35,000, it's going to come from some place. It's either going to come from my front pocket, and I'm going to pay it out of one of my accounts, or I'm going to go borrow it through a private money lender. And I can leverage 100% of the deal if it's structured correctly. So whether you're a realtor, these are the deals that you can bring in. If you're a wholesaler, these are the deals you can assign for a fee transactionally. If you're a private money lender, we're going to get to that screen in a second. We'll show you how you can how you can get a solid return secured by the asset fully amortized. I'm going to show that too. Okay. And if you want to be an investor like I am, and you want to just generate cash now, cash flow, and cash later, this is the deal I'm going to do. So this is the same deal that I do all the time. And like I said, if you're interested in this one, just reach out. You can go to support@nickthenoteguy.com. Send Elvia a message, say, hey, I'm interested in this deal. If you're interested in this deal, send a message. If you're interested in being a lender on this deal, send us a message. If you're interested in getting leads on these kinds of deals, we'll show you that as well. Or if you're just interested in just coming in and bringing them in the community and having us help disp them, we can do that too. Okay, back to the model. So here we go. So we know the existing debt right now is a 229 unpaid balance. All these expenses right here add up to $33,500. Okay. And then I got to put in the existing loan details. Okay. I have an unpaid principal balance here. The total PITI is 2021. I don't personally care about the PITI because guess what? I'm a lender on a wrap mortgage. I don't get any benefit of taxes and insurance. That's the county gets the taxes and State Farm gets the insurance. Okay, I am the lender. I only get principal and interest, just like Bank of America, Wells Fargo, Chase. That's what they get. They don't get taxes. They got to defer them. They don't get insurance. They're not an insurance company. The total P&I is 1,071. The current interest rate, 3.75. And when we solve this, the remaining term on this mortgage is 328. Now, why is this important? Well, there's a couple things. As soon as I get to this point in the evaluation, I already know at a very high probability this is the deal. And here's the reason why. I know the interest rate's low and I've got over 30 months of pay down on this. Okay. Those are two factors that will contribute to this. Now, what I don't know yet is it worth the property worth this much money? And that's probably the main thing. And we're going to check that here in a second. So right now, what we're doing is we're going through the model at a very slow pace. If I wasn't having this commentary, I can do this in about 2 minutes. Okay. Or I can have an assistant do this initial evaluation. So here we go. So now we know what our debt is. We have our debt. Now, guys, if I had a seller carryback right here, or a second lien, or a third lien, or a fifth lien, I can continue to add notes here. Mortgage notes, not notes, but mortgage notes. So if there was a silent second there, I could put it in there. If it was a hybrid deal and the seller was going to carry $50,000 down, $50,000 back in payments, I can go create that mortgage right here and create a brand new amortization table. This particular deal is not. Future deals, when we get to those, we'll do them. We're going to go to the next screen. Now we're going to talk about the property itself. What we're going to sell it for. Okay. I got it 275. Okay. And we're going to break this down in a second to see if these numbers are true. And we're going to go use third-party verification data. Don't take my word for it. Don't take your agent's word for it. Do the research that's needed to validate the true value of the property. Because a lot of times when people sell properties and they create financing, they overprice them. That's fine if you're going to stay in the deal because you're the bank. But if you ever want to leverage this debt and either sell the note, parcel the note, hypothecate the note, any of these things that would be on the back end, you better structure the deal correctly because we are not real estate investors when we sell it on a wrap. We are lenders to consumers or lenders to investors. So super, super important to understand that. That's why USA Home Partners is there. That is a nationwide transaction management solution company that is the umbrella for these transactions. So if you have a deal you want to look at, go back to Nick the Note Guy, go to USA Home Partners, and you can get all the information you need. Okay. So here we go. So now what I'm doing here, this is in the Dallas-Fort Worth market. Personally, if I'm writing, when I model, I always model conservatively. I'm getting about 9.75 to 10.25% right now on a owner finance, wrap mortgage, seller finance, or whatever you want to call it, to my customers, my clients, my home buyers in the Texas market sub $300,000. So in this here, I'm doing two loans. When I was talking about leverage and hypothecation note, this is what I'm doing. We're not going to break it down here. Get a deal first and we can break it down. I always write two liens on my wraps because I understand the value of underwriting. I understand the value of correct note structuring. And I know that by creating, if you look at this, the interest rate on both of them is the same. The term is the same. And they're both the same. Okay. So all I did was take one note. Instead of doing one note for 247,000, I'm doing my first at 206, my first lien wrap at 206, and my second at 41. Okay. And the reason being is because I know if I need to do something, I need to have a get out of jail free card. But because if I structure it this way, I can get out of these deals quicker, get more money, and still have some cash flow in the future if I structure them correctly. Okay. That's why we do it. Go write one note. Don't underwrite the buyer. You do whatever you guys want. I'm just telling you that I follow best business and banking principles. We think, act, and be a bank. The whole point of this is if you're going to do this market, if you're going to use this strategy in your market, you better be doing it like a bank does, or otherwise I would highly recommend not doing it, putting an assignment fee on it and throwing it over the fence for somebody that knows what they're doing. Okay. The good news on all this is that you don't need to know all that. You just need to know that you need to utilize resources that are there. You need to use the right attorneys. You need to use the right transaction management company, insurance providers, servicers, compliance offers, all that stuff. Well, that's all built in as a conduit through the software. Okay. It's not all ours. It's just, we're going to give you the right tools to use. So if you're going to do this deal, you have the best possible chance of success moving forward. Because a lot of people fail right here. They don't underwrite the buyer when they sell it on a wrap correctly. They don't do insurance properly, or worse, they they incorrectly structure the note, or they borrow private money the wrong way. These things are huge problems if they're not done right in the event of some kind of situation in the future. All right, let's continue on with this. Let's go to the next screen. So this is why we do two notes. Okay, so acquisition funding. We know we need $33,500 right now. Okay, it's got to come from somewhere. It's not going to just mysteriously appear at closing. Okay, you can use a private lender. You can use your mom, your dad, your grandmother, whatever. Okay, you can have the seller carry it back. We've had that before. That's sort of the hybrid deal. Go, look, I'm not going to give you $33,500, Mr. Seller. How about if I give you $33,500 in the form of a note, and I will give you 15% for 60 months. You knew that. Same difference as what we're doing here. We're just going to default it to third party. So what does that look like? So right now, I know I need $33,500. Okay. I already have a lender for this deal right now at 16%. I only borrow, me personally, do whatever you want to do. I only borrow money that's fully amortized. Fully amortized. You need to understand what interest only is and what the impact is, and you need to understand what amortization is, because this is what we do. So I only borrow fully amortized. So if I'm doing this deal, I'm borrowing $33,500. I'm paying my private money lender 16%. Just trying to highlight these. I don't know why it's doing that there. And in my term is 60 months. Okay. So that means I am going to pay $814 a month. Sorry, I'm outside. There's a truck over here. $814 to my private money lender, and I'm still going to get cash flow of $195 a month, or you're going to get cash flow of $195 a year if this is your deal. And in 60 months, I'm going to get more because then my private money loan's paid off. Okay. That's what this means. So I usually pay on second lien debt somewhere between 14 and 18%. So if I had to pay 18%, I can just change this to 18%, solve the payment, and it still cash flows $159 a month. Okay. But I already got an investor for 16%. So private money lenders that are listening and watching this, you can come into a second lien position with this property with 3.375% debt, lend $33,500, get paid 16% interest, 60 months fully amortized, and you can get your $850 a month. And if I was a default, you could take all this over and take over a 3.375 debt. This is why we don't have problems with what we do, because we structure it correctly. We protect our private money lenders first. Look, if I have a new lender, I could come in right here and I could say, you know what I'm going to do, Mr. Lender? I'm not going to take any of my $159,000. I'm just going to lower my term and raise your payment. Let's see if I can get my 48 to work. I can solve it right here. I can go down a little more. I'm just changing the term. Look, instead of giving you 60 months, I'll give you all the cash flow, which is $1,000 a month, still fully amortized for 44 months at 16%. Okay. That's what it says. You can create this, you can share it, and this is how you raise private money for these deals. Just do a video, just do it just like I did. So I'm going to go back to what I already got agreed to. I want to mess up this calculation. Okay. Back to the 814. So we still don't know if this is a deal or not. We're getting close to this. Okay. I just want to walk this through at a slow pace so you guys have a good understanding of what this is, and then how to get these deals, how to find them, how to fund them, how to dispose of them. All right. So when you get to this disposition exit strategy screen, it's an okay screen because I only use it for one thing, but it's built for multiple things. Cash offer. If you were a traditional wholesaler and you wanted to get a wholesaling fee on this deal, you would have to make a cash offer of $206,500. Okay. If you're going to well, we already know they owe more than that. They owe $229,000. Is the seller going to write a check at closing for $30,000? Unlikely. Is it possible? Sure. highly unlikely. So this is not a wholesale deal, traditional wholesale deal. It doesn't fly. So you better know how to structure it creatively if you're going to negotiate direct with sellers and get them to understand creative financing so you can get a deal and do it. So now you finally got the seller to say yes to the creative. So now you got to figure out how you're going to exit. Well, you can exit to a traditional buy and hold investor. Well, they're going to lose $335 a month while that private money is being paid back. Is that a good model? Not for me. Maybe it is for some, isn't for me. So that model doesn't really work either. But what does work is the sub two acquisition with private money, in this case, in a second lien position, and generating some cash now, cash flow, and cash later. So what does that look like? So right here, this says right here that while I'm paying back my private money lender that at that high interest rate, I'm still yielding $195 a month in net cash flow. These are all net numbers, guys. After that gap funding is paid off, I go over to $1,000. Okay, that's what this means. So let's look at now the actual. Let's look at the actual profit analysis. Okay, so when I look at this profit analysis, I'm looking at it a couple of different ways. The first thing I'm doing is I'm solving for a 10-year plan. Why do I use 10 years? Well, because I know most homeowners are staying in their house 12 to 13 years. If I do the right job, when I negotiate with the seller, when I buy it, and I disclose everything properly to my buyer when I sell it, this is what I know to be true. Okay. Does it mean that something can't go catastrophically wrong and I got to get out of this deal in 42 months? Absolutely not. We deal with probabilities, not possibilities. It's a high probability that this deal will stay in play for 10 years because I'm going to control the narrative of this. I'm going to control the seller by the way I communicate with them when I purchase it. But more importantly, I'm controlling the deal when I become the bank because I have stuff like right of first refusal to buy the property back, right to be able to refinance if the buyer wants to get refinancing. I can do all this stuff. Okay. This is all stuff that's taught through the Creative Dealmaker Academy, which is another link in there, which Michael will handle that stuff if you need more advanced stuff. I'm only talking about the software. So here we go. So what does this look like? This is my profit analysis. And I do it this way, same way every single time, whether it's a sub two deal, because whatever it is, because I can compare apples to apples. I always put 120 in. Okay. I always solve for that term initially. So what does this say? It says cash now, 82.49. What does that mean? That means when I sell this property to my new wrap buyer, my net is $8,249 minimum. We've already built in all the expense to close this deal. Closing costs, seller concessions, commissions to the agent, listing fees, all that stuff, it's already in there. Because if you remember, if I go back to the property sale, there's $27,000 in down payments, okay, come from the buyer. Well, why am I only getting 8,200 back? Well, because there's a lot of cost into doing a deal, okay? So it's netting out. Typically, this number is much higher than this, $2,000 to $3,000 higher, but we always model conservatively and we built it in. Cash now. Cash flow. What does that mean? This is net. So it means that over this period of time, 120 months, my cash flow, my net cash flow accumulated is $72,334. So you remember the first 60 months, I have a high amount of money going out to my private money lender. I'm only making $195. Then it goes to $1,000. That's the total there. Then I have another cash later. This is the payout, the payoff. In 120 months, I'm just using it as a forecasting. It means when I sell the note that I get that I have with my borrower, or they pay off the property, or they refinance it, less the cost and the payoff that I have to the underlying bank, the net difference on those two is another $54,785. It's the net difference on the amortizations. Think about it like this. When you go to buy a house or you sell your house, the title company asks for the payoff. That payoff comes from the bank. Who's the bank? Well, you're the bank. I'm the bank. or we use a third-party servicing that gives us the updated payoff information, and they say the payoff is X, okay? In fact, it's right here. Here's my property purchase right here. So if I go out to just some arbitrary number, in November 30th, they ask for payoff. My payoff on my underlying debt is $194,000. That's what I owe Wells Fargo, Chase, whoever it is, the seller, whoever it is in this situation. And then these are my debts that I have coming in. So I have assets and liabilities. And the notes that I create are my assets. The notes that I owe money on are my liabilities. Okay. The net on that is $54,785. So the total net profit on this deal, right here is $135,369.29 forecasted in perpetuity over 10 years. Okay. The net monthly recurring revenue over that time period is $1,128.07 a month. Okay. So people go, well, what happens if it gets paid off or something happens in 5 years? Okay. Well, then go up here and change it to 60 months. It's still worth $56,000. Now, I will tell you right now, I would not do a deal that only is going to yield me $56,000. That's why I have my minimum criteria. My minimum criteria, monthly net recurring revenue needs to be a minimum of $800. My total profit on the deal needs to be a minimum of $100,000. Okay. This is why we do it this way. This is why I do it this way. You can do it anything you want. Some people go, well, I can get cheaper capital. Great. Go get cheaper capital. Some people go, you know what? I'm happy with $80,000 because I'm just going to put it in my IRA. Great. Take the deal. You get control of all of this. Okay. So this is the deal. So right now, this deal is available. Somebody wants to come up with $33,500 and wants to wrap it. This is their cost. That's $33,000, and this would be the projection that I would calculate out. So now the next question becomes, well, what's 7516 Meadow Creek even look like? Is it really worth $275,000? So outside of software, I use a couple other tools that I highly recommend that you guys look at. So the first thing I do is I go to realtor.com. Okay. Why realtor.com? Well, you can use whatever you want. I'm just telling you what you want because it gives me 4 or 5 answers to questions that I want to know the answer to. The first question is, what does the property look like? Most of the time I can get pictures. Here's the pictures. This is a pretty clean little house. I'm not touching this house. I'm not doing anything. Okay. I have no problem putting an owner occupant buyer in this house. This is why my rehab number was 0. Okay. That's number one. Number two, I do get an estimated value right here of 277. Think about it like this for a second. This is a offer that's coming from a company that's in the real estate space to make money. So if they're going to offer me 277 and they're going to turn around and make money off it doing something else, then it's probably worth more conceptually. Okay. But I don't even care about that number. The numbers I do care about is when I get down here, the real estimate number. This is my favorite thing here because now what realtor.com has done, they sort of did what Zillow used to do with their Z estimate or Zestimate, whatever you want to call it. Instead, they went out and they're buying data from 3 of the largest data providers: Quantarium, CoreLogic, Collateral Analytics. In fact, I believe that CoreLogic is still the number 1 provider of raw data to almost all the MLSs nationwide. So they provide the raw data. The MLSs come in and they do their ARVs or the AVMs, whatever you want to call it. They use that data. So you have 3 data providers right here that are providing an unbiased value based on data. Okay. You can also see the progression up and down of the value, but let's just go out to what the value is. I'm just going to leave it right here. Right here. Here it is. This is projected for October of 2024. Quantarium's 277, CoreLogic 272, Collateral Analytics 267. That is a really tight spread. So I have no doubt in my mind with a high degree of probability this house is worth $275,000. No doubt. I don't need to go get an appraisal done. I don't need to go get a BPO done. I don't need to go ask my realtor friend to go run me comps. You can, and there's nothing wrong with it. I'm just saying after doing this as many times as I've done it, I have a 90% plus probability that my price is in here. So when I know it's there and I know the other numbers that I put into the software are there, I'm good to go. So now I know that my price is good. The last thing I want to look at is I look at the ZHVI. Okay. ZHVI stands for Zillow Home Value Index. Okay. And if I go into Google, all you got to do is go to Google, type in ZHVI 76123, and it'll pull up this page. And what is the Zillow Home Value Index? It's the average home values in that zip code from, of everything. So the average means what? Middle. Well, the average is 314. What am I selling my house for? 275. But think about it logically. If a home buyer is going to be buying a house, do they want to be on the high end of the neighborhood or the low end of the neighborhood? Okay. They definitely don't want to be on the high end. Now the house could be worth $100,000 more, but the value isn't really there because it makes it harder to sell. So right here, I have my last variable that says this is a deal for me, and it's my ZHVI index. If this house was 375 and it was worth 375 and all the numbers show that, would I do this deal? Maybe. Okay. I want to probably dig a little bit deeper, but look, these houses are going pending in around 20 days. Look, you can knock Zillow all you want, but I'm gonna tell you right now, Zillow is the best source of data. There's so much data on Zillow. You can go down here, you can see the map here. If you want to change this to just single family homes, you can do that too. You can see that it went up and then it dropped back down. That's okay. Things go up and down all the time. Okay. But look, no one had a problem 7 years ago when it was 187, and even though it went back down, it's down to 314. Look, this is it. Here's all your median stuff. This is what I do. Okay. So I'm going to go back and recapture the deal again real quick. So we moved around a little bit. And now that you've seen these numbers, this is what you can be doing. So I'm going to go back to the deal value. I'm going to go back to the very beginning and do a quick 2-minute overview. Okay. So I'm going to go back to the beginning, here at the very beginning. Address goes in. We obviously don't need any rehab. Now you know how I came up with the as-is value of 275. Okay. If you want to go Rentometer or Z-Rent or whatever, great. Go put it in here. Doesn't matter. This is subject to deal. Means there's an existing mortgage. I didn't share with you the mortgage. I just put the data in here. This has an agent fee, a wholesaler fee, and a real estate agent fee. So we're paying $12,000 going to whoever found this deal to get these deals. If you don't want to pay that money, then get the deals yourself. I'll show you where to get that in a second. Closing costs, $4,500. Cash to seller, $17,000. I could change any of these. Like if you decided, you know what, I really want $250 a deal. Let's just make that one assumption real quick. Let's just say that you want this number to be $250 a month. Okay, so how would you change that to get to the 250? Well, that means you got to borrow less money if the rate and term stay the same. So how do I borrow less money? Well, the only things I'm going to be able to adjust if I go back to the property purchase right here is what? What are my variable costs? Cash to agent, assignment fee, cash to seller. Okay. So let's just say, you know what? I'm going to give the seller $15,000. I'm going to offer $4,000 to the assignment fee and $6,000 to my agent. I'm going to go back over here. I'm going to go back to funding. I'm going to resolve it. Now it's $292. That little bit made $100 and something difference. Okay. That's how you manipulate the data in the model to see where you want to be. Even if it was negative, you can just keep doing it. So just because they're asking for it, why the software is so powerful. So let me go back to where it was. I don't want to mess this model up real quick. This was 7,000. Oh, hang on. 7,000 here, 5,000 here. And we're going to open up the questions here in 1 minute. Okay. And cash to seller was 17. Okay. We know all that. Let me go back and resolve my funding. Make sure this goes back and it's correct. Okay. So going back to the property purchase, we have a little bit of flexibility here in the negotiation. Okay. Property sale, I would not adjust this. Now, I will tell you this, I'm probably asking 295. Okay. But I'm modeling at 275. Okay. I might be asking 10 or 10.5%. Go plug those numbers and see what the value of these deals is at that doing that. Okay. We already know all this information. So the one thing I want to show you real quick, because we have different people on this call. We have realtors, wholesalers, investors, and private money lenders. Okay. So let's talk about the first one. If you're a wholesaler, okay, if you're a wholesaler, this is your line right here, 5,000. Well, if you want 10,000, then guess what? You got to have your agent come down a little bit and your seller come down a little bit. Because anybody that understands the amortization isn't going to give you any more money. Okay. 33,500 is probably the max cash out of pocket, max cash out. Maybe 35,000. Okay. Because you're not going to want to get into a cash negative situation on the cash flow. Okay. So that's your option. So could a wholesaler change this to 7,000? I don't know, change it to 7,000. Go back to your funding, solve it. Yeah, you could probably pull 7,000. You might even be able to get 8. Okay. Agents. Why is a realtor want to understand this model? Why would they want to consider this? Because when they do the same thing, they can go back to their seller and say, look, we can get you $17,000 net cash at closing. If we do it traditionally, assuming we can find a traditional buyer, you're going to get 8. Which one do you want to do? You want to hold out for a potential retail buyer that has to get comps and an appraisal and inspection done and get pre-approved from Wells Fargo and hope that they'll pay 7.5%? Or do you want to take more cash and hope and rely on the investor that you're selling it to do what they're going to say they're going to do? Which one do you want? It's not the agent's responsibility to tell them if it's a good deal or not. It's the agent's responsibility to tell them what their options are. Hey, here's your term sheet. Here's your net sheet. Hey, this is worth 8,000. This is worth 28,000 or 17,000, whatever the number is. Let the seller decide. Agents, that's what you can do, because if you can take that, put it in here, you do the same thing. You have your fee up here or whatever it is. This deal is very sellable to the right audience. Okay. Realtors, you can take advantage of it. You can go to Creative Realtor Network. We'll go through those in a second and do that. If you're a private money lender and you want to find, you want to get into real estate, hey, here it is. Here is the deal. I need to borrow $35,000. I'll pay it over 60 months, fully amortized. There's an amortization schedule right here. In fact, I can pull it up right here. In 60 months, I owe 0. Okay. The principal pay down and interest, here's all it is right here. It's an amortization schedule. Okay. Would you want 16%? I'll give you 16% for 60 months, $863 a month. And they go, no, I don't want to do 16. I want to do 18. All right. Well, let me put 18 in. Now I have to make a decision. Do I want to do this deal at 18%? Yes or no? I might say, you know what? I'll do 18, but I want to do 72 months. These are all yours. Okay. Change all of this. Okay. Private money lenders, they can see the deal. They can see the underlying debt. The other advantage to a private money lender, even though they're technically in the second lien position, okay, they also get, when we do it, at least, they get what? They get the right to take over this. They get the right to take over, because they can, if they had to foreclose on whoever it is in the second lien position, guess what they get? They can take over this also. Anybody that understands amortization and understands debt would love this, because they're going to take over 3.375 debt if I default on it, get abducted by aliens or whatever. And all they got to do is make a payment of $1,071, and now they're controlling a $300,000 house. This is the value. This is what you guys got to understand. What a private money lender does. They're trying to look at 2 things. They're looking at their yield or their investment, their yield on their investment, and they're looking at their risk. Okay, so even though the ratio is high, meaning we're at 264 cost basis on a 275, so that's almost 100% LTV collectively. The value isn't the LTV. The value is being able to come in and take over $229,000 at 3.375. This is a huge value to them. Okay. Trust me. It's what we do. It's what notes guys do. Okay. This is why you have to understand the banking side of this. You don't understand it. This is where you guys get screwed on the discount when you try to go sell your note. Okay. So this is super important. So who did I leave out? And us as the investor. Okay. We've already got this deal in here. I think I changed something here when I changed the funding. Let me go back and put the funding back at 16. And then the last on this equation is the note holder, the long-term note holder, the wrap note creator, me, you, whoever it is. Okay. Let me solve this again. And this is our deal. And the question that you got to ask yourself is that A, do you believe these numbers? Is it obtainable? Can you find seller finance buyers? Well, the answer is yes. The industry is $30 billion. 65% of the population can't get a traditional bank loan. Okay. The numbers are definitely in our favor. Okay. And it's not going to change. Okay. But here's what I'm looking at. Am I okay getting 100% leverage on this deal and collecting 82.49 now, 69 in cash flow, 54,000 later, and a total profit projected of $132,000 and leveraging the whole deal? Now there's work that got to be done. You got to find your buyers. You got to find the property, all that stuff. And the question is, it depends. The answer is that it depends. The question is, does it make sense or not? It's up to you. Okay. I'm just telling you, this is a deal for me. I have deals that are way better than this in my portfolio. I have deals that are less than this in my portfolio. Okay. Some of them are seller financing with seller carry back debt. Some of them are hybrid deals. Some of them are sub 2 deals. And this is it. This is it in a nutshell on what it is. So private money lender, if you're a private money lender and you want this kind of deal, or as in your investment portfolio, and you're okay with somewhere this return, reach out to us. Okay. You can reach out to me directly. If you're an investor and you got $35,000 or you have access to 35,000 and you want to play the cash now, cash flow, cash later game, great, reach out. If you want to learn how to structure these deals, we'll do that too. So let's go ahead and see what we have question-wise, and we will get this done. So let's go into, let me go ahead and turn on my video screen over here. If anybody's got a question, we can raise their hand. Let's see here. Yeah, so we have that in here. How do you decide the amount of the second lien? Okay, that's a great question. Okay, that's where the transaction management company comes in, USA Home Partners. Ask your TCs if they do this for you. And I'm going to tell you right now, if you find anybody that does, they probably learned it from me, learn it from us, because they don't. They're going to go write you your standard single note. It's no different than attorneys that don't practice in certain areas of law, or CPAs that don't understand installment sales, or a cardiologist that doesn't know how to fix an ACL. Doesn't mean they're not good at what they do. They're just not good at what we need them to do. Okay. You need a TC that understands creative financing, for example, that understands note structuring and how to be a bank, not how to push paper from through the process. Anybody can do that. So the question is, how do I know what I'm going to write it for? So I'll tell you exactly how. When I go back, let me go back to the sale here. And so in this one right here, the underlying debt right here is on the first. I'm really trying to protect my first lien holder. Okay, I have other things in my agreements with my private money lenders or my seller carryback that allow me to do different things. But in this particular one, I know that if I go to my purchase, my debt is 229. Okay. So if the bank calls this note due, they're going to ask for a payoff of 229 roughly. So how do I get 229? If this note gets called up, ask people that have notes called. By the way, never had a note called due that went to foreclosure. Never once. Thousands of transactions, never once. How is that, Nick? Because we underwrite correctly. Okay. We protect our investors and our investments through the process. Okay. So what I'm going to do is I'm going to write 2 notes here, and I'm going to write the first one. I'm probably going to change this. Right now it's a 206. I would probably overwrite this to call it 235-ish, okay? And then the other one's only going to be 12,500. Why did I do that? Okay? Because I know that if I underwrite the buyer correctly, because of the ratio of this first lien relative to the true value, that I can go find a buyer for this note if I stock the file correctly and do it properly, that I can get pretty close to my bank payoff debt. Guys, think about that for a second. I don't ever have to worry about a note being called due if I structure it right, because now I just told this $235,000 note. I collected my $229,000, paid off Wells Fargo. Okay, now what happens? Well, Wells Fargo's gone. I replaced them with Bob Smith. He put it in his IRA. Well, what else do I still have? Okay, what do I still have? In this case, I still have a $12,500 note at 9.5%, paying me. I got to resolve this. Hang on, $105 a month. I solve this one. $105 a month. Now, that doesn't sound like a big deal, but it's better than losing money on the deal. And the value on this is still about three to 3.5x, depending on where it is in the thing. So this is still worth $30,000, and I don't have any money in the deal. I have no risk. I have infinite ROI because now I have a free and clear, in this example, $12,500. Not the worst thing in the world. Now, I'm not planning on selling this unless I'm forced to sell it. Okay? Why would I sell it? So it doesn't matter what I write the first and the second for from a ratio standpoint if I'm keeping them both anyway. This could be at 200,000 and this could be bigger. They're still mine until I'm for. I don't sell it unless I'm forced to sell it. How am I going to be forced to sell it? Well, the bank calls the note due. Well, how is the bank going to call the note due? Well, it's because I didn't do something correctly, or my seller wasn't educated properly when I bought it, or something like that. Okay. And even if that was the case, I still have time on my side. So this is the structure on that. So that is it. I'll just leave that there. It doesn't change anything. Let's go back to the chat. How do you decide the second lien? Oh, so the other way I was going to say on the second lien. So when our buyer goes to underwriting, again, something you don't get from most transaction management companies because they don't know, because they've never. Guys, I sold this exact system and process to a 100-year-old federally chartered bank in 2018. I went through 9 months of due diligence evaluating what I do from creating a mortgage notes and the underwriting of the process. Okay. I can promise you there's very, very few people on this planet in this space that understand and can do what we do. I'm not just saying that because I do it. I'm just telling you, go look it up. There's a reason why we do all this stuff. It doesn't mean you have to agree with it, but it worked for us and it was good enough for a bank to buy it. And if it's good enough for a bank, it's good enough for me, and it should be good enough for most of you people. All right. So let's go into this. Do you need a license to do this? So that's a great question, Michelle. There are some rule changes that are coming out that are not in effect yet, where there's going to be some potential situations where you have to be a licensed RMLO. The lender has to be licensed. Up until this point in time, you could use a third-party RMLO. It's still, they're still in, it's probably going to pass. I don't know, but there's always an answer for that. Okay. But technically I own the property and I can sell or finance it because I am the owner of the property. I don't have to have a mortgage broker's license to sell my own property if I'm the lender. If I was going to have somebody else is going to be it, I can't lend for somebody else, if that makes sense. So as of right now, and until it changes, it doesn't change. Okay. In some states, such as North Carolina, by law, you can't wrap around the loan that doesn't belong to you. Well, I don't know what that means. Okay. I know what it means. I know in the state of Texas, the Texas State Senate passed a bill called SB 43, Senate Bill 43. Go read it. In fact, it tells you can do this. Okay. So if North Carolina passed some law, I don't know the laws in each state, but you have one of the best attorneys in the state of North Carolina, and Harry Marsh. I've had conversations with him. We've collaborated before. Ask him. Okay. That means you can't wrap around subject to deals any alternative solution. Well, I don't believe that to be true based on what I'm reading here. But hey, I don't know everything. It could be true. Okay, I would love to see it in the state statutes, because the federal statute says I can. Okay, there's not one thing in Dodd-Frank that prevents me from doing this. Okay, I just have to disclose. Okay, so if that's the case, go do these in another 49 states. By the way, 23% of all seller financing is in the state of Texas anyway. Okay. So what other questions do we have? Let's see here. Give me 1 second, guys. All right, sorry about that. I had a little bit of situation there. Somebody was trying to do it. Okay, so let's see what other questions we have here real quick. I don't have the answer to that. That's a great question, Michelle. On that, I don't know. Okay, let's see here. Nazir said if the seller is willing to owner finance but wants a down payment, how do you subordinate? That's a great question. Okay, that's not going to cover that right here, but that's all part of the. There again, another great question to ask your transaction coordinator, because this is exactly what we would do. This is why we built the whole USA Home Partners to do all this. We always subordinate our seller in the second position, and it allows us to go borrow money cheaper, because now I'm putting my private money lender in a first lien position. Well, I'm not paying him 15, 16%. I'm paying him 10 to 12 because he's got a low loan amount and that's still secured by the same asset. So we'll probably do one of these on one of the next Deal or No Deal live calls, and we'll do one on that sets up exactly that way. Okay, there's a lot of other value in doing seller financing as well. Let's see here. Yeah, so we subordinate them through paperwork. Okay. Let's see here. Also, is there a tax benefit in installment sales with the seller? Well, there again, I'm not going to give legal or accounting advice. Okay, but there's definitely an installment sale has some tax advantages, especially if it was a house that was an investment property, like tired landlords. If they bought the house at 200 and it goes to 300,000, if they were to sell it outright, they would realize $100,000 in capital gains. Whereas if they were to sell it on installment, they're only paying relative to the monies they kept coming in. There again, I'm not giving it tax advice. That's it. There's IRS code and law that tells you what an installment sales is, but highly recommend you seek out a CPA or tax advisor that understands installment sales on your side as well as the seller. We always refer them to their attorney to ask the question. Okay, we don't get in the middle of that at all. But yes, there can definitely be tax advantages to selling on terms. Okay, let's see here. About paying on subject to deals. Do you ever pay off the underlying lien? Not unless I have to. No, there is some. So 98% of the time, the answer is yes. I mean, we don't. We leave it. We don't pay it off, right? And the reason being is because why would I pay off 3.375% debt? Okay. Okay. If I had hard money on it at 10%, then I would, and I'd restructure it. Here's a situation where I've done it where we paid off underlying sub two debt. The house is worth $250,000 and the seller owes 50. Okay. So we'll bring more money to the table to cover some cash to the seller, closing costs in the 50. So maybe I do 75,000. And then I make the seller carry the balance. So I'll bring the 75 to closing, give the seller 20, pay off the 50, subordinate the seller in the second lien position, get a private money loan in the first lien position, and then now it just converts it from a sub 2 deal to a seller finance deal. But if your debt is over 75, 80%, why I'm not ever planning on selling it off. Never. Okay. So that's it. Okay. I hope that answers that question. You try not to. The reason you want to do subject to deals is the interest is normally much lower. That's correct. Understand. Okay. You can pay it off anytime if you want to. Yeah, I'm not sure why you'd want to pay it off. What's the name of the law? The statute is Senate Bill 43, SB 43, in state of Texas. Okay, SB 43 tells you exactly what you can and can't do. That's why having the right underwriters, the right attorneys, and the right servicers in play make all the difference in the world long term relative to these structures. So got somebody spinning around over there. All right, let's see here. Yeah, so Ryan, we don't have time to go over the deal today. If you want to send it over to support, we can look at that too. But we're going to cut this one off right now, top of the hour. Yeah, so is there any other questions relative to this deal before I change the screen share on this? Anyone else? Let's see, we'll check the chat, make sure I didn't miss anything. And Ryan, we can talk offline on the other one. Let's see here. Okay, Ellie said great. Okay, super. So last thing I want to show you real quick is where your access to all this stuff is. So if you go to my page right here, you scroll to the bottom. Sometimes we'll put a deal a week up or something. There's one that we did. This one was worth I don't remember what this one is worth. I can't see it on here. It's not on here. But guys, if you need help with note creating on something, or you want to sell a note or leverage a note, just go to the website, just click on it, and just go through it. Okay. I'm not going to go through any of this stuff now. If you want to learn how to structure these deals, then go to Creative Dealmaker Academy. This is on more for the negotiating side. Some people are already in the Academy. Michael is going to take the lead on that moving forward on that. That's what that's for. If you want to be a member of it, go to it and see what's available. I show up and I speak into that group on occasion, but really it's the precursor to understanding how to use the deal, because you got to find the deal first, and then you have to be able to negotiate the deal. You can't find and negotiate, then the deal evaluator software is irrelevant. Okay, you don't need it. Okay, deal evaluator is great once you have a deal. Okay, USA Home Partners. This is where you want to go if you need help with transaction management. Another company, they can do a nationwide transaction management solutions, and they will create it the correct way, either with their internal team, or they will work with a team that's in another market and make sure they have the blueprint to do things the way that I would do them in those. Then you have USA Lead Machine, very important. Matter of fact, I think we have a promo code. Elvie, do I have that in the chat? I'll show that here in a second. If you guys want these leads, like you need leads, like this deal, could very easily come from an outreach. You can go right here. You can learn all about the lead program, how to buy leads that are high quality, motivated seller leads. You can click on this link right here. You can see it all right here. Right now it's $29.95 for 20 qualified leads, guaranteed the deal. But more importantly, I think there's a code. I'll pull it up here in a second that you can use there.
I put it in the chat.
All right, you put it in the chat?
Yeah.
Okay,
yeah.
so if you go there and you want it, I think they're doing USA doing the first 50, you get a 50% discount, and then once that's gone, I'm not sure if there'll be another discount code or not, but it's in the chat. So you would just go to USA Lead Machine, and then you would put in you would just go here, and then when you go to order, you would just put it in there. I don't know. I don't manage this right here. You can just go and do it. All I know is that for every 20 leads that you get, you should get between 1.2 to 1.3 deals per that. So it's a solid program, and you're not screwing around doing a bunch of other stuff. What else do I have on here on the bottom of this page? Give me 1 second. I'm on the wrong page. Give me 1 second to go back. Then there's the deal evaluator. Guys, if you don't have deal evaluator and you get a deal, just go to the page. There's a video right here that talks about it, but this is where you can come on the calls that we do. And if you're not a member, you can get it right here, and you can just get it for free, 30 days. You don't get access. There's no cost. Okay. It's just a discount in there. So you can go and get it and try it for 30 days and then bring your deals in. And the last thing I want to show you is the Creative Realtor Network. So if you're a realtor and you have these deals and you need help structuring them, we have a whole community of investors and all over the country that helps you not only helps buy deals from your sellers, but also can help you structure them for back end potential buyers that you may have that need help finding a deal or structuring a deal with creative financing. So that is all that I have. We will make this recording available. If we have any other, let me just check the chat one more time here. Let's see here. Elvia put it in there. Let's see if there's any other questions. Yeah, just go to USA Lead Machine. There's the promo code. I don't know how long it's going to be up. I don't care. It has nothing to do with me, except I will tell you this, is that the leads that you get from there are really, really good. I use them for my leads too. Okay. I get deals direct from seller. I get them from USA Lead Machine, get them from agents through agent outreach. And I also get them, from people that are just that I'm on their list. So, do I need I do subject to deals in order. Do you land money in the second position in North Carolina? No, but there's a whole bunch of people that do. If you structure the deal correctly, most private money lenders want to know that their money is protected structurally from a documentation standpoint. Okay. They want to make sure that the paperwork is right, because they don't understand what this stuff means half the time anyway. So they want to know, and they're going to probably come to somebody like us and vet the deal and make sure that it meets the criteria that we would deem fit, like a bank does. Okay. So there's private money out there. We don't teach Raven private money. There's a lot of great educators out there that will teach you how to raise private money. I don't raise private money, because all I do is I go take that deal right there, and I say, who wants to lend $33,500 on a 16% return on a 5-year balloon? And here's what we're going to do. And here's what it looks like. Here's the asset. And I make a little Loom video and I send it out. I put it to my investor list, and first come, first serve. And I usually will get 3 or 4 people that want it, just based on what we do on the video using the Deal Evaluator software. Super, super important. All right. I think that is it. We're going to wrap this one up. Guys, hope you find value in this. We will do Deal or No Deal lives periodically. Make sure you go to the YouTube channel and you subscribe, because I think if we go live and you're subscribed, you'll get notification. You also get notification when I post these, because I don't do all of these live, because what I just spent an hour doing, I can do a deal analysis and show you the same things in about 8 minutes. So you can go watch 12 of these or 10 of these, whatever it is, in the same amount of time. But if we do these live throughout, the course, 3 times a month, so you can answer questions, or if you have a deal and you want to bring it on, we can do that. Okay. So if you have any other questions, let me know. Happy to reach out. Just go to the Nick the Note Guy webpage, go to support, send us an email. Any other questions, let us know, and we will see you on the next episode.